Hi, everyone. Thank you for joining us today at our second event of this year's Digital Asset Compliance and Market Integrity Summit. My name is Alyssa Ostrov. I'm the Chief of Staff at Crypto Compare. Today, we have an exciting panel that will take a deep dive into the balance of growth and regulation and what that means for digital asset firms in the midst of the maturing regulatory environment that we're in. This year's DACOM is a bi-weekly series of 4 panels that will run every other Thursday until the 3rd of December, discussing the most pressing issues in digital asset regulation, compliance, and market maturity. If you enjoyed today's event, we hope you can join us for upcoming sessions. Our next one is on November 5th, and we'll discuss the journey to a crypto ETF. For those of you who missed our fireside chat with CFTC Commissioner Dan Berkovitz a few weeks ago, I highly encourage you to check it out. You can watch the whole session on YouTube. It's on both the Crypto Compare and Solidus Labs YouTube pages. And this year, DACOM is proudly brought to you as a joint effort by Solidus Labs and Crypto Compare in partnership with Global Digital Finance.
Thank you, Alyssa, and thank you everyone for joining us today. I'm Chen Arad, I'm the Chief Operating Officer of Solidus Labs. Just a few quick words about us, the hosts. Crypto Compare is a leading digital asset data company that caters to corporate, government, and retail clients. Their premium data and analytics provide a comprehensive, granular overview of the market across trade, order book, historical, social, and blockchain data. Us at Solidus Labs, we offer the first comprehensive crypto-native market surveillance and risk monitoring hub for digital assets. Crypto business globally work with us as part of applying for licensing, attracting institutional investors, protecting their users, and generally growing faster and safer. As Alyssa mentioned, DACOM was established to promote standards of compliance, market integrity, data, and regulation standards. And today's panel is really a report from the trenches of the people who are promoting this day by day. Our speakers all have vast Wall Street and traditional experience, or in Alex's case, experience working as a regulators. And 2 years ago, when the industry and its regulation was really at its infancy, they nonetheless decided to take the regulated path, which wasn't always easy, or maybe wasn't ever easy. I'll let them share their experiences. The industry is really at a watershed moment where it's clearer than ever that regulation is the path to growth. They'll be sharing challenges, successes, best practices, and tactics. We also have the privilege of having Teana Baker Taylor, Managing Director of Looking Glass Labs, as a moderator today. Both Alyssa and myself had the opportunity, like many others, of working with her when she was Executive Director of Global Digital Finance and really led the design of a comprehensive set of code of conducts for this industry. She's been a true leader in this industry, which among many other recognitions gained her the status of one of the most influential women in fintech. And by that, Teana, over to you. Look forward to it.
Thanks, Jen and Alyssa, very much for having us today. It's a pleasure to be here. I'm Teana Baker Taylor, and I'm delighted to be the event moderator today. As crypto regulation continues to evolve worldwide, crypto compliance professionals are really navigating the complexities of commercial growth within this evolving regulatory environment. And it's my pleasure to be joined by a panel of highly esteemed industry executives from leading regulated digital asset firms to discuss the challenges and successes and hopefully share some best practices for growth from a compliance-first mindset. Our panelists today represent second-generation crypto asset platforms, so younger companies that were set up to launch as fully regulated and with ambitious growth objectives. So it's my pleasure to welcome Sherry Noonan, CEO and co-founder of Realta Markets, Antonio Brass, CEO and co-founder of Blockquake, and Alex Royal, CCO and Head of Regulation at Archax. Thanks, you guys, for joining.
Thanks for having us.
Brilliant. So I'd like to invite each of you to introduce yourselves and the companies that you work for. So please tell us about your journey into the digital asset space. Personally, I think it's very interesting. What brought you here? What did you know about the space before you decided to make the switch from traditional finance into digital assets? And how have your views evolved since you did make the leap? So Sherry, let's start with you.
Sure. Thank you so much, Tina. So my name is Sherry Noonan. I'm the CEO and co-founder of Rialto Markets. And my journey really started with the electronification of the U.S. equities market. I was involved in that back in the 90s and spent a large part of my career really building and operating electronic trading platforms. First, I was at Instinet, and I met my two co-founders there. And then I was at Goldman when banks began buying and integrating electronic trading platforms into their larger franchises. And then I was at Deutsche Bank, where I began really as the COO, a journey as a COO. I was first COO of global electronic trading, and then the COO of global equity derivatives and equity trading. So, my career was really firmly in traditional finance, but I really learned that to build new products in a highly regulated and very nuanced world, you really need to focus on the regulatory infrastructure. And I saw how difficult that can be, especially when you're trying to scale quickly and build the infrastructure that can withstand really that step change when you're going from MVP to production and scaling quite quickly. And then finally, since my roles were really global, I saw the differences in rules around the world and the fact that you couldn't just drop a trading system from the US into Japan or into Korea. There were real differences and nuances, both in the workflow and the regulations that needed to be addressed. So Rialto Markets is a broker-dealer and alternative trading system. And we began this journey two years ago and really saw an opportunity in the private markets to utilize blockchain-based securities, digital securities, to shift the private markets and build the rails for the private markets in the US.
Fantastic. Antonio, tell us a little about you and Blockquake.
Sure. So Blockquake started back in January 2018, and prior to that, I actually spent over 15 years in regular financial services, banking and insurance, global banks and insurance companies, working in internal audit. So I've touched everything from financial audits to investment audits, technology audits. I've done a lot of risk compliance audit work, touched on a lot of regulatory work in that time too. So this has always been top of mind for me. And just through those experiences, I just personally traded stocks, options, FX before I got into cryptocurrencies in 2016, 2017. And my foray into this space with Blockquake really came to fruition at the end of 2017 when myself and other startup members on my team were trading cryptocurrencies, and a lot of the platforms were crashing. You didn't know who owned what. They were disappearing, running away with your money. And at the heart of that, it was really a lack of transparency and oversight that we saw that was missing. And we didn't really see any platforms out there trying to address this. So come January 2018, we started Blockquake to go down this road of trying to build a regulatory focused crypto and digital asset exchange that would be global. And when I talked about my regulatory experience, I actually got to touch on a lot of regulatory matters, both domestic here in the US and overseas. So it's just very top of mind. If you wanted to be a global company, you needed to really focus on more than just what's around you.
Yeah, absolutely. Alex, what about you and Archax? I've been, personally watching your evolution over the last couple of years and know you guys well. So congratulations on your recent MTF license. Tell us about that journey.
Yeah, so I think just on my side, my sort of experience is very much anchored as a market participant, maybe sort of similar to Sherry in some extents. And then during that time, spent a time in the market throughout the sort of the 08, 09, 10, 2011, 2012, interesting sort of period in the markets where we saw a very definitive shift from sort of maybe participant-led markets to, let's say, a more of a regulatory oversight and compliance-led steer coming into the markets. The response was very much anchored within regulation and legislation, and that kind of opened my eyes to it as a market participant, the need to engage and engage proactively with that side of the industry, and that sort of prompted me to sort of pivot slightly, and I moved over and started my sort of regulatory career as I moved over to the FCA, and as my entire regulatory career has always been based within the infrastructure side of things, always secondary markets. I spent a bit of time in ESMA over in Paris for a couple of years, very much at the sort of the forefront of the legislative and policy making process. And as my time there, this question of digital assets and tokenization and sort of all the STOs was sort of really starting to creep in and sort of piqued my interest in the interplay between legislation and technology, and fundamentally where these sort of markets are going. And as a sort of a victim of Brexit, and it's kind of brought back to the UK out of Paris slightly early, I was then looked for sort of opportunities where I could sort of apply that kind of thought process to both the legislative side and actually get my hands dirty again back in industry, and met the Archax guys, and that's where I started there. And Archax themselves is, as Teana kindly pointed out, we've become the first secondary market institution, and we got our MTF license concentrating very much in digital assets, and similarly in the UK. We have this new a new standard bearer for AML KYC in what has been sort of dubbed AML D5, the fifth directive, and we were also one of the first people to be formally registered with the FCA as being AML KYC compliant within the crypto space. And so now we've received all of these authorizations. We're very much in a stand-up process, looking to sort of launch formally, probably at the back end of Q1 next year, as we sort of engage with dotting the I's, crossing the T's, and making sure that we do everything properly over here.
Great. So from a regulatory perspective, we often debate whether policy and frameworks are creating net positive results, or if this new asset class is being retrofit into an old world architecture. And all of your companies adopted the regulatory first approach to digital asset services, and you've had success in your engagement with regulators. So thinking holistically across this journey from business plan to launch, what were the challenges that you had to overcome during these authorization or licensing processes? And what best practice guidance can you give to other companies that find themselves in a similar situation? Alex, let's start with you.
Yeah, sure. So I think the very first thing to kind of understand and the way to engage with regulators or the like going down this journey is to understand and appreciate that fundamentally legislation and regulation is a rear looking tool, and a lot of what people in this space are really trying to engage with is that forward looking, right, what's coming next, and these two things naturally they cannot sit together. So there has to be some interplay there, and understanding that one of the guys around here says you can't boil the ocean. You've got to take bits, and you've got to understand and take people on a journey with you, and go on the classical journey and understand actually classical traditional systems and controls, which is really what we're talking about when we get into the operational compliance side, that they exist for a reason, and they are broadly technology agnostic. So whether or not you're engaging with the latest technology and the latest infrastructures, the systems and controls must be the same, because they exist in order to protect end users. Your end users are no more sophisticated in any way, shape or form than they were, whether they just because they're going through a new app or engaging with a slightly new wrapper for a new project or something like that. And I think understanding that and realizing, particularly in the UK, that the regulators want to work with people in the UK. The regulator has the sandbox, which is probably one of the most open and great and fantastic tool in order for people to engage. And I think using that platform to engage in that manner will really sort of grease the wheels for any other firm looking to kind of take that journey.
Yeah, indeed. Sherry, Realtor was approved as a tokenized security ATS by the SEC. Talk us through that process and what you've learned along the way.
Absolutely, absolutely. So we worked with FINRA on the approval, and the SEC was integral in those conversations as well. And it was a 2-year journey, two and a half year journey. And it was really walking through first education as to what we were trying to do and how it fit within the bounds. I love what Alex said, because that's exactly right. How, regardless of the technology that's being implemented, how the controls were being met from our obligations as a broker dealer and as an operator of an alternative trading system. So we spent a lot of time working with the regulators and walking them through how that framework worked. And then there was a lot of time, explaining the differences to different members of staff along the value chain. It's a massive value chain when you think about the financial infrastructure of the United States that's been around for a very long time. And so there were many different teams to meet with and communicate with regarding the implications for their specific function. I think from a best practices perspective, because financial markets are so deep, the breadth of knowledge that is required and the depth of knowledge that's required, it's so deep. So having a team around you that really understands each of the functions in a very, very specific, very deep way is critical. Because you can't boil the ocean, but there's no one person that knows the absolute ground level of any function. And so we've been really fortunate in having industry veterans around us as we built out the entire operational and technical flow.
Antonio, how about you and Blockquake? So what's Blockquake's journey? The process kind of led you to have a better understanding of the last couple of years.
Yeah. Just similar to what both Shari and Alex said, we're going through the bit license process right now. So, I can relate to everything Shari just said, where there was that part where we had to educate regulators. There were many meetings with DFS, and there'll probably be a few more as we near the end of that process. And we do plan on going for our BD ATS as well. I think what I advise like brand new startups jumping into the space to do is be proactive. I know at least particularly here in the US, a lot of brand new companies, they see regulators, whether it's at the state or federal level, as like the boogeyman, and they're afraid to engage. They're human beings at the end of the day, and reach out to them either directly or through your attorneys. They're more than willing to sit and talk. They're trying to understand the space as well, and it's helpful if you do that more up front than waiting till later. From my prior work experiences as a technology auditor, you don't want to end up in a situation where you've built your technology stack and you did not account for a lot of the tech agnostic stuff that Alex referenced, and now you have to go do remediation efforts. That is a nightmare, and you definitely want to avoid that.
Well, so you've all brought up this interesting point around having the right people involved in the business. And this historically has been an industry that emerged from more of the tech space, not necessarily the regulated financial space. And as a disruptor, and going deep into some of the crypto participant ideology, it was not necessarily designed to operate in a centralized finance governance mechanism, where we're starting to kind of find ourselves coming to the convergence of that space today. So, what role do you see from, the difference between maybe, Shari and Alex, you guys came from traditional finance, and Antonio, looking at this from a technology perspective, where is that convergence between building credibility and then therefore commercial differentiation How does that be having the right people on board? What's the balance of that, I guess, is what I'm asking.
So,
I-
All right.
so go ahead.
Why
No,
don't
no, I was going to say you go. Yeah, off you go.
Yeah, I guess me coming from a audit background where I touched everything, the one thing that I realized is you have to put together the right team, but you need people on your team that can really, from the outside, look in and see what you need, what gaps you need to fill. When I served roles as a technology auditor, one of the things that I saw that worked was when you created this traditional SDLC lifecycle to build an application or build a process. You had multiple parties involved. It wasn't just tech people. Like you said, most of the people in the space previously were just pure technologists. There were technologists involved. You had audit compliance risk people involved. You had business or client-facing people involved. You really needed all those different opinions to get the complete picture of what was needed. In this case, you also need people that understood the regulations at play. And my recommendations to people is make sure you have each of those roles filled, that you get that complete view of what needs to be put together.
Sherry?
Oh, thank you. So I was going to come at it from a slightly different angle. When you were talking about companies looking at this, really, if you don't have the frameworks in place to mitigate risk and to cover the regulatory framework, you're not going to get the innovator's dilemma bell curve from the super early adopters into mainstream financial services. You're never going to make that leap because there's just such a huge swath of the market that they're not up at 3 a.m. Coding and interested in reading Reddit, and so they're just not, and they're not going to be able to adopt the systems, the new innovation until the risk has been mitigated, until the frameworks are in place. And so really that's the clash that I see when sort of you've got this, burn it all down versus absolute stoic regulatory framework, is because you're never going to get that mainstream adoption. So if that's what the industry wants, it's going to need a framework within which to build from.
Yeah,
Alex, anything to add?
Yeah, I think there's sort of the way I kind of think about it when we're looking at the traditional versus the incumbents versus the sort of the newcomers coming in is, and we consider it from a regulatory point of view, really what you're looking at are two things. You're looking at either products or you're looking at activities. And I think realistically, the new technology or the new world, if you like, or the digital assets is very much a product based. It's a new product based world, but it's all operating within the concept, the well-defined concept of the traditional infrastructure space. So there's no new activities going on here. Secondary markets are still secondary markets. Primary markets are still primary markets, but the framework within which the assets themselves differ, that's where there's some interesting things here. So I don't actually think it's as much of a leap as I think some people I've spoken to are there. And I actually think that an awful lot of the existing and traditional world just maps over perfectly into what is just a new asset class. The benefit and what we've seen now and the real positive engagement we're starting to see from legislators and the like is the acceptance that this is or this new asset class has novel factors and novel facets to it, as opposed to trying to pigeonhole and push it into the classical understanding of a security or a derivative and things like that. And I think it was at that point when things were trying to be shoehorned and pigeonholed naively maybe, that we saw a lot of this kind of butting heads between the old and the new, or the traditional and and sort of the and the newcomers into the space. But now in the UK or in Europe, we've seen MiCA, and we're seeing new attitudes towards crypto asset promotions and things in the UK, and etc. Things like that. We're really starting to see a positive focus from legislatures, and I think that's only going to act as a more cohesive response to bring these two worlds together and actually understand the traditional guys are going to, the traditionalists are going to understand, well, these guys are just doing exactly the same thing, just maybe in a more economic or efficient manner. And I think someone used the kind of the more zealotous side of the new, the new asset class are going to realize that they're not doing anything new and novel from an activities point of view. So they have just as much to learn from the other side. And until the two sides come together and we see the likes of new firms trying to do new things, getting old licenses and finding that wrapper being made, being brought around the whole thing, then that's what's going to bring the kind of the legitimacy that the new asset classes really need, and sort of bring the institutions on, as sort of Shari alluded to.
Well, we'll get to institutions in a minute, definitely. But before we do that, I just want to go back to some of the new regulatory announcements that we've seen over the last couple of months and weeks, actually. So we've been asking for more regulatory clarity for years. And in September and October alone, we've seen major advances on that front with the announcement of the Markets and Crypto Asset Regulation in Europe, or MiCA, the SCA Acts, and the DCEA Act in the US Congress, and the Blockchain Act was approved in the Swiss Senate recently. So there is a lot of net new bespoke regulatory activity happening, as opposed to retrofitting, which I think is quite positive. But simultaneously, we're seeing an awful lot of enforcement activity, and that seems to have gone to just a whole new level, with some quite high profile actions being taken in the last couple of weeks. So I guess the question is, are we there yet in terms of regulatory clarity? And more importantly, how does the either lack of or the seeds of new shoots of clarity impact your business, the commercial growth of your business? Let's start with you, Antonio.
Sure. So this actually, you bringing that up takes me back to a conversation I had with some old audit colleagues back in the summer of 2018. They went on to work with various regulatory bodies and ran into them by the South Street Seaport down here in Manhattan, and just shooting the breeze. And their perspective was that all existing regulations apply, and we just haven't enforced it yet. That's what was said to me, and that was the approach we took. So I look at it from that lens that we are in that position, fortunately, to build things from the ground up, and just all we can do is take what's out there that we do understand and work with it. And yes, there may not have been as much clarity before, and it's coming now, but we should never come off as just flagrantly negligent. For putting our best foot forward, regulators see that as they're looking to provide clarity, and they look toward enforcement. I think that matters, just putting the due diligence in and having that show.
Well, Sharon, you and I spoke the other day, and kind of boiled it down to a security is a security is a security, no matter how you wrap it up, right? And Archax also operates in that security space. So you could argue that this doesn't necessarily impact the commercial growth of your business, but yet I think it does.
So one thing I think that's important for everyone in this ecosystem to realize is, just because there hasn't been an enforcement action brought against a particular firm doesn't mean that that's not being viewed or looked at. It takes the SEC a very long time because they have to be extremely careful, extremely diligent. So it just takes a very long time for these to come to light. So it's really important that, everyone knows that the regulators are looking at this now. So if you're operating in the United States, if you're operating with US citizens, just be aware that it is better to, engage regulators and make sure that you understand the framework within which you're working. I don't think 2020 is a year where someone can say, well, I didn't know people were interested. That's not going to be an acceptable response. And the SEC is very open to having conversations and to engaging, as is FINRA. So it's just, there's no ability at this point in time in this day and age to say, well, I wasn't clear. That's not going to be an acceptable answer.
Well, and I think, in Europe and the UK, the enforcement methods are slightly different in that it's not necessarily, fees and fines and sanctions. Us individuals are held accountable, Alex. So, I don't know if that helps or hinders the commercial growth, but if your senior leadership is personally on the hook for money laundering regulations, for example, and you are bereft, I think that definitely has a knock-on impact in your ability to commercialize at pace.
Yeah, I'd agree with that. I just want to go back though. You made a really interesting point earlier and brought up the concept of regulatory clarity. I think you'd still be hard pushed to find anyone who would genuinely say there's perfect regulatory clarity in the traditional world. Okay, there's arguably less regulatory clarity in the digital assets world, but I view that as a positive thing realistically, and it goes back to what Shari was saying about having the right people and engaging with the right things and the right expertise and the right roles. Because if you're talking about innovation, and if you want to innovate and if you want to push the boundaries, innovation within financial markets happens within the gray areas of the regulation. If you have an exhaustively codified set of rules, there is no wiggle room there for any innovation at all, because you just don't have the rooms to operate. Whereas actually an element of regulatory uncertainty, or let's not say that, or a lack of absolute clarity, in that gives you space able to innovate. And you can therefore, and those are the areas to look for. And I think sort of, and speaking a little bit from experience in my previous lives, that's kind of why some things are left open. They want, regulators want market, they're in the business of propagating markets. So why shouldn't they ask for a market response to certain issues? And the concept of moral hazard and regulatory overreach is never too far away, particularly in the UK kind of regulators and legislative mind. So being very, very sort of mindful of that, you need to therefore understand or work out how you want to engage with the grey areas of regulatory or lacks of regulatory clarity. And you can choose, it's a personal choice to operate kind of in good faith, or you do it in bad faith. You can take the rule doesn't say that, therefore I've got the wiggle room to do whatever I want, therefore I'll go and do it. Or you can say, well, I understand what the principles of regulation are, I understand what the spirit of the law and what the spirit of legislation is.
Yeah.
I understand what that is, and so I'm going to interact in that. I'm going to interact with this intentionally left grey area and try and do the best that I think. And you're right, if there is an element of personal culpability, then maybe you think about it a little, it focuses the mind ever so slightly than let's just set aside some money and pay the fine and then get on with it. But I think it comes down to, I personally enjoy an element of regulatory, a lack of clarity. I think if there was no clarity, I wouldn't have a job. So that's kind of that. I think about it in that, and actually I think that's where all innovation has come from. We find an inefficiency either with the system or with the legislation, and then we innovate our way out of it. And I think that is a market response, and I think that's positive, and that's where growth actually comes from.
Yeah, I think I would agree. So we're kind of at the halfway point in our session today. I just wanted to let the audience know that we will leave some time for Q&A at the end. There is a Q&A button at the bottom of your Zoom screen. So if you have any questions for the panelists, please put those into the Q&A, and I will keep an eye on those, and we will save some time to get to your questions. Okay, so moving on, going back to the institutions. The proverbial we, have all been saying for years that the institutions are coming and that they will bring with them hyper growth in volumes and value. But regulated institutions need regulated counterparties. And so I guess the question to you is, are they actually coming? If not, what's it going to take to get them involved? And, I'm going to start with you, Shari, because you mentioned this earlier. Is institutional grade infrastructure and services, have they evolved enough to actually be ready for massive institutional adoption?
So we have now created within the ecosystem the components along the value chain that can scale quickly with that step change. So when you think about a brand new open field, greenfield approach, there are certain components along the value chain that when you're building an MVP, you can build and say, let's do this manually until we get the traction, the use case right, the growth. And then the regulated framework, there are certain components you can't, like risk management, like AML KYC. You can't leave that to some process that if you scaled quickly, you couldn't accommodate in a manual way. And so we really focused on building out those components of the value chain to be able to handle the scale. When I think about institutional adoption, we are really starting with those components of the private markets that need the scale. For example, Regulation A within private markets. But I will say within the last 6 months, certainly since we were approved in our mandate, the interest and engagement from traditional financial professionals, from the institutions, has shifted from this is interesting, let's just wait and see, to a more active dialogue. And that's very different because they're seeing that they're seeing that regulated framework being set up and being activated, for lack of a better term.
Yeah, Antonio.
Yeah, I think on our end, so we've taken a very third-party approach with our trading platform, and I found us working with institutional partners have really helped, such as Solidus, Fireblocks, and Prime Trust. We've been approached this year with significant dollar flow for our platform. So I'm finding that as these type of vendors really step into the space to address a lot of the institutional needs for different pieces, people are slowly coming on board. That's been my experience throughout this year. And it really just took the last 2.5 years for a lot of these vendors to come into the space, right? All of us on this panel, we've had all these thoughts and ideas of what needed to happen years ago, and we're now slowly starting to see people catch up. And I think we're going in the right direction, but it's still very much at the beginning.
Alex, are the institutions coming?
Yeah, well, we certainly see a lot of interest in sort of all aspects of what we're doing, and have had a lot of interest from institutions of all types. I think a lot of it may have been driven partly in because of our engagement with the regulator and whether or not we were going to sort of meet the threshold, meet the hurdle, because that sort of lets other people know where the regulator kind of sits. So we're a bit of a canary in a coal mine kind of interest there. But broadly, since becoming authorized, that kind of opens up an awful lot of opportunity for us within the institutions, because various institutions are limited by the types of infrastructures and firms that they can themselves interact with. So since we've become authorized, yes, we are, we do see a lot of interest. How that materializes when we launch, we'd definitely be optimistic, but we're also very, very realistic in the sense that we're not going, this isn't going to revolutionize the world overnight, and to a certain extent, I think most people will recognize first mover advantage is always a very, very positive thing, almost except in the case of liquidity. When no one wants to be the only player in the market. You can't trade with yourself. So, so you need to, well, you can, but it's very naughty. But so you need to, we need to kind of be mindful of that and realize that there's going to be a bit of a growth story here generally, and the people that are going to be the foundation of that growth story are not likely to probably be the big household names within the institutional space, but we're very we're confident and pleased and encouraged that we know that they are looking at it and will, it's very much a case of if we build it, they will come, but but probably not on day one, but maybe day 2 and day 3. But yeah, very positive engagement from all institutions on our side, which is very promising.
Tokenized securities have been a promise in the space for a while, and talking about trading with yourself, there have been successful proof of concepts, there's been issuances, but we're still lacking a true secondary market. There seems to be a slow shift in the regulatory mindset from a bit of fear and FUD to Jay Clayton saying recently that everything is going to be tokenized. So this does feel like a big piece of the institutional puzzle for me. Do we believe that we can reasonably expect to see volumes of tokenized security trading growth in the next year or two actually increase? And how do policies like the Securities Clarity Act affect that growth? Sherry, I think you have an opinion on this one.
I do. So definitely, the way we approached it was we really looked for a component of the market, the existing market, that had a lot of friction associated with it. So like I said, markets. And then we looked within that private market framework and said, okay, where is it that a use case for blockchain-based securities would make a lot of sense, which is, needs massive scale. You can't really efficiently transact without having scalable infrastructure like blockchain-based securities for example, Regulation A. So we approached it from a different angle than, creating and launching a security token. And so we took existing companies that were already in the market, traditional companies, and some of them don't even realize they're launching these on blockchain-based securities, but they are, because that's the most cost-effective way to handle their capital formation needs. And that's the angle we're working from right now, and it's proven to be really a positive because you're offering mitigated friction in the secondary market. You're really offering a secondary market to issuers and investors that couldn't previously access that. And that's a value add, and you're not so much talking about the technology behind it, but the value proposition in front of what you're offering. And that's how we've really driven a lot of adoption in our space. And I do think that Clayton coming out and talking about that everything's going to be tokenized, I think you're going to see just traditional companies, regular companies looking to raise privately first, and then you'll see a lot of the more interesting implementations that can really shift the capital formation paradigm, which I get really excited about. That's going to come next. But first, let's just do the base layer, basics, and move from there.
Yeah, I was just to echo, I can agree more with sort of what you said, and sort of the two bits from that resonate very highly with me is the concept of friction. Basically, it's the concept of frictions and rent, and I think a lot of people accept that a full engagement with the sort of what this technology is able to do will remove an awful lot of known and understood and just accepted frictions from the trade life cycle, and therefore will reduce an awful lot of what most people view as unnecessary rent gathering along the way. And therefore that will make the, you know, the process of raising money, capital allocation, capital and sort of and general raising, you know, raising and getting capital to where it is needed the most at the most appropriate time. It'll make the whole process easier and cheaper. We in the UK and in Europe have the concept of, you know, the SME, small and medium-sized enterprises, and there are various carve-outs or sort of equivalent safe harbors for SMEs over here. And actually, alongside the crypto, MiCA kind of push that we're seeing in legislation, we're also seeing an awful lot of work trying to promote the SME growth story, which is sort of where Archax is, and probably, you know, is really where we're anchoring a lot of our issuances at the beginning. And as Shari correctly says, you know, you've got to engage with that traditional side of things, show people where we remove all the frictions and make the process a lot easier and cheaper, which will take some time, and then the true innovation can really, you know, can sort of really come forward. I know there's another talk next week about, you know, the concept of ETFs and things like that. That, you know, that's a phenomenally exciting area to move into, but you know, realistically that might be day 2 down here, because what Shari's already pointed out has to happen first, really.
Antonio, anything to add on the tokenization of everything?
I am on the same page with both of them. I think that that is the right approach. We have to focus on tokenizing essentially some of the existing marketplaces. That comes with an inherent built-in liquidity. So, you know, start there. As Alex said, some things that are more frictionless.
Great. Okay, we have a number of questions from the audience. I think what I'll do is pose them to the person I think might have the best opportunity to take a stab at it, and then please, the rest of the panel just chip in. So let's start with you, Alex. This is just for you, actually. Did Archax develop through the FCA Innovation Sandbox program before getting approved for its MTF, or was it a direct application?
Yeah, it's a good question, especially in light of what I mentioned earlier and sort of highlighting the FCA sandbox. It was actually a direct application we went through. It initially was scoped by the innovation team and the sandbox, and the concept, it was deemed to be probably too complex an application sort of at face value to go through a sandbox. And so we were encouraged to go directly and sort of, I guess, roll the dice a little bit more, which was great, because it kind of focused our mind and focused our culture and attitudes to one of, right, you know, we don't have a safe harbor here. We're not riding with stabilizers. We need to engage as if we were any other MTF, and that, as it was. It took a long time, and it should take a long time. I think people need to understand it. These processes need to be difficult, and they should take solace in the fact that it is a difficult journey to go down. But I think in the long run, for us, not going through the sandbox and engaging directly with those that will ultimately regulate us from day one has been a positive, a really positive experience for us.
So, you know, Commissioner Pierce has thrown lots of ideas out around safe harbor for the US. Shari, would that have impacted, well, I guess both of you, Shari and Antonio, both, would that have impacted how you came to market with your businesses initially, if that had been in place, like a sandbox going back to 2018?
So we worked with the SEC's financial innovation team while we were going through the process, but the safe harbor, Commissioner Pierce is incredibly approachable and very open to ideas and looking for ways to move this forward from within the SEC, which is fantastic. And you know, while it would have addressed components of the product line, going back to Alex's, you know, product and activities, it wouldn't have actually, you know, we still needed to get that mandate for the base business that we're going after. So it wouldn't have impacted for Rialto.
Okay. Okay, Antonio, I'll throw this one at you. When it comes to compliance requirements around AML and transaction monitoring, considering the volumes of transactions could spread across customers, how are exchanges approaching the costs around those compliance requirements? Are exchanges taking a risk-based approach, or is that are all customers on the platform constantly being monitored, and are those costs being recovered from users?
So our approach has been to try to automate as much as possible. So we're working with chain analysis on the KYT side and Prime Trust on the KYC AML side. And so they're all cost involved, but by automating it, we are actually able to run everything through our level of risk management that we've set without seeing exponential costs. So for anyone interested in trying to review as much as possible that kind of flows through AML and KYT, a lot of it is about pushing it to automation so you can look at every transaction and you put flags in place. So if it hits a certain flag or a trigger, you raise it up to something that needs a secondary review, or you block it depending on what your risk profile is. So that's what we've employed, where we set certain thresholds where certain transactions are just straight up blocked, and then others are kicked to review.
I think it does raise an interesting question, though, around the cost of doing business, right?
Yeah.
So if you had been operating either in an offshore entity outside of a jurisdiction that had a regulatory requirement, or in a jurisdiction that didn't have a regulatory requirement and they do now, that cost of doing business around user acquisition is significantly higher when
Yes.
you're having to employ all of this, AML, KYC, transaction monitoring, diligence.
Correct. Yeah. So if to that situation that you just described, for someone going through that, they may have a heavy manual process if they've got to pick that up, and that will definitely be a monetary burden. We assumed that this was coming anyway, so we baked it in to pursue automation to really control the costs.
Okay. Anybody else have any comments on that? No? Okay, move on. Oh, go ahead, Alex.
Oh, no, sorry. I mean, just to add, sort of on our side, the AML KYC side of it is something that is the processes that we have to go through are pretty well defined. And so there's not much. I know we spoke earlier about levels of certainty, but there's not, the new kind of standards that have been introduced in the UK. There's only about 3 or 4 firms that have kind of been registered for them. And so at the moment, we're probably not in a space where we can benefit from opportunities of scale and things like that. We need to see how these things embed a little bit further, but needless to say that I think our attitude here at Archax is one of, costs of compliance exist for a reason, and we seek to engage with them as opposed to sort of bypass them. And I think that's broadly felt by everyone on this panel.
Sure. Yeah.
I'll just add one last thing. Completely agree with Alex and Antonio. It's really just a cost of building the platform. So you have to build the platform, assume that cost, and then as you scale, those costs become, from a unit perspective, less.
Well, you guys did, but there will definitely be players in the market that didn't. And now, going back to the remediation, the cost per acquisition may have been whatever your marketing costs were, distributed out amongst all of your users, and now you're having to do A, B, and C, and your cost per user goes up to $15 a person. Is it worth it to be onboarding all of those customers who may not necessarily pay for themselves if they're doing a one-off transaction here or there? So I think it is a different evolution paradigm for those businesses that didn't build compliance first from the beginning, I think is probably the argument I'm making here. Okay. Curious to hear more about thoughts on enforcement activity. What do you guys think is spurring it? and what trends should we be aware of?
I think I mean I can start, but will be sort of maybe more brief. I think Sherry highlighted quite correctly earlier that these things take time. So when you see enforcement actions coming out, when things are made public, it doesn't mean that they picked it up yesterday or they picked it up a week ago or they picked it up. Some we've seen from indictments and things like that. Some of these things are going back years and years, and that's sort of a clear thing to a clear differentiator between the legal process and the regulatory process. If you see, I know it's closer in the States than it is maybe over here. But I mean, on the point of what should people probably be aware of, I mean, the law helps, and so that's probably a good place to start.
Indeed. So in kind of a similar vein, Sherry, like broker-dealers who can rely on a no-action letter framework for AML delegation to reliance on investment managers, how can digital asset trading platforms safely do the same with custodians?
So from a digital securities perspective, we don't rely on anyone. As a broker-dealer, we have built our own infrastructure and are responsible for that infrastructure. The Series 24, the principal is responsible for making sure that everyone in the platform and trading on the platform can be there and is consistently monitored. And so we don't rely on any no action framework, no action letter.
Okay. Antonio, anything to add on that one?
No, I agree with Shari. I think that's the long-term approach on securities, whether it's tokenized or otherwise, to be the BD and be your own custodian.
Okay. I think we have time for one or two more if we're quick. Let's see. Would like your views on original issuance STOs and what you think the killer app category sector will be.
Alex, do you want to start?
I mean, we're seeing the original. I think it depends how you're going to sort of define the original STO side. I think when we saw this kind of STO boom and everything, we got to be mindful of the fact that some of the things that were going on at that point and the money being raised and what is it, and the manner in which it was raised actually is what turned legislators' eyes to the space with real urgency. So the attitude towards them, I don't have a strong view one way or the other. It would very much come down to a case by case basis. But what I would say is that the recent stuff coming out from MiCA and the like, and the engagement with things like white papers and prospectus regimes, the need for legitimate admittance documents. One of the big learning journeys that we go on with people seeking to become admitted onto the Archax venue is one of understanding the threshold that they as an individual company need to meet independent of Archax, just to be able to meet the regulatory threshold in order to be admitted as a financial instrument on a regulated venue. And there's a bit of a journey and a bit of a journey you need to take people on, both us as a new venue and people seeking to engage with venues potentially for the very first time. So it's great conversations we do kind of have, and a lot of it is a lot of these guys or a lot of these people are very much anchored in what went on a few years ago. So there is that educational piece, and it's really positive to see now the legislators coming along that as well, and actually going, well, no, we're not going to demand £100,000 800-page prospectus to come through for an SME growth market to come and raise some money. That's ridiculous, and thankfully people are really starting to engage with that positively. So I think that's probably what I have to say there.
Brilliant. Well, we've come to the end of our time. I'd like to thank each of you so much for joining me today. It's been a fantastic conversation. So very quickly before we go, we literally have 1 minute left. How can people get in touch with you to learn more about you or your company? Antonio. go.
Sure. They can go to blockwake.com, or all of our social handles are the company name Blockwake, or follow me, Antonio Brass. That's my social handle as well. Thank you.
Sure. For Rialto, you can go to rialtomarkets.com and you can find me on LinkedIn and social media.
And for Archax, you can go to archax.com and reach out to us. Feel free to. We're very responsive and looking forward to hearing from you. And similarly, reach out to me directly on LinkedIn and socials.
Great. Thank you so much. And thank you, Crypto Compare and Solidus Labs, for having us. Have a great day.
Thanks very much.
Sure. Thank you.
Bye-bye.